What is going on, traders? Welcome back to the Traveling Trader. In this video, I'm going to be giving you something that you have all been asking me for, a tutorial on LEAP call options, how to execute LEAP call options on your favorite stocks that you think are going to be worth a lot more within 2 to 3 years time. So we're talking about stocks like NEO, some of the cannabis stocks, Palantir, for instance. So stocks where you can almost foresee the true value in a couple years time. Like in my view, there's almost no way that NEO won't be at least $100 stock. So in this video, I'm going to be giving you a full tutorial on LEAP call options. This is going to be beginner friendly, and I will also give you some examples on an advanced platform like ThinkOrSwim as well as Robinhood, because I know a lot of you guys use those two platforms. Obviously, you can use any platform, but hopefully I cover most of you guys while using those two platforms and showing you real life examples on how to execute those orders. So without further ado, let's get right into it. And as always, if you get anything out of this video, leave it a big fat thumbs up just like this. Leave it in the comment section below. Let me know if you're engaged in any LEAP option plays, and if you are, on what stocks are you executing LEAP options on. And if you want access to our private trading group, link is in the description. I'm running a promotion for Cyber Monday, 15% off annual memberships. It's limited, so you will want to take advantage of it if you want to get a nice fat discount. And one more thing, I've been getting a lot of requests about doing an options course. I am in the process of recording that. I'm going to leave a link down below in the description where you can sign up with your email for early bird discounts on a future options course. It's just to let me know that you are interested, and anybody on that list will get a nice discount. And I think it'll be the most complete options course out there. We will be going over a lot of strategies, iron condors, leaps, how to do vertical spreads, the basics of calls and puts. I'm going to cover the entire spectrum as much as I can. All right, so what are leaps? Leaps are basically just long-term options. That's really it. And the term stands for long-term equity anticipation securities, but it is exactly what I'm telling you. They are just publicly traded options contracts with a forward-looking date. And usually that is, I mean, again, it's a very loose term. Most people would classify it as a year or longer. Some people do 9 months or longer. Either way, it is a long-term option. Now, we're just going to be covering leaps in terms of calls and not puts. And don't worry, for the beginners, I'm going to be explaining what this is. Now, a call option is basically a derivative of the stock itself. So a call option on NEO, for instance, will allow you to buy 100 shares of NEO per contract. In the US, each options contract represents 100 shares. So it'll allow you to buy 100 shares of the stock at a certain price. However, options can be and are usually traded as speculative derivatives, meaning people trade options with the intention of just generating more cash and not really with the intention of actually buying 100 shares of the stock per contract. So let us not focus on the share ownership aspect of it. Let's just think of call options as a derivative that follows the stock itself. And these derivatives also have a dollar value, right? So these options have a dollar value. When you're trading options, you're buying and selling them for a dollar value. All right, so when we're talking about options, and again, in this case, we're just going to be focusing on leaps having to do with call options. So when we're talking about call options are bullish derivatives, right? So when you buy a call option, you basically want the stock to go up, equals bullish, right? And the call options have the same bias as the stock itself. So when the stock goes up, right, when the value of the stock goes up in terms of dollars, then the call options also go up. And the reverse is true. When stocks go down, call options go down. So firstly, you are best off buying leaps or buying call options when the stock declines in value. Why? Because then the call options will be cheaper. So just because a stock declines in value in the short term doesn't mean that your long-term outlook isn't bullish. So for instance, again, let's go back to NEO, for instance. If it drops to $35 and you really want to own that stock, for sure you're going to be buying it because you realize $35 is an exaggerated discount for the long term. So you're best off buying call options during retracements, right? During pullbacks of the stock itself. So let us just go over to Robinhood and look at some example call options. We're going to pick some random ones and see what the pricing is like. Now, the advantage with options is that your capital commitment is actually a lot less than buying 100 shares of the stock. So if you look at NEO, for instance, currently it's priced at $53.92. Let's just call it $54. So if you bought 100 shares of NEO right now, it will cost you $5,400. Let's just pick an arbitrary call options contract here. The $50 contract expiring December 24th costs you $875. Remember that in the US, each contract represents 100 shares. You will have to multiply this by 100 to get what your cost basis is. So in this case, if you bought the $50 calls on NEO, it's going to cost you $875 for this expiry. Now, the reason that options cost a lot less than the shares do is because of this time commitment. You have to be right, meaning that the option or that the stock has to move in the direction of your option, in the favorable direction of your option, for you to make money, right? And it has to do so by this date. So it is essentially like a bet almost, and that is why it costs a lot less than buying the stock itself because of this time value. All right, so we got the basics out of the way. Call options are bullish when the stock price goes up, the price of calls go up. When the stock price goes down, the price of calls go down. It allows you to control 100 shares of stock. All right, so the next logical question is, what tells you how much money you will make if the stock price goes up? How much money you'll make on your call option? So if you bought a call option, an arbitrary call option, how do you know how much money that call option will make if NEO goes up to a certain price? So if NEO gains, $5 in its stock price, how much do you stand to make with your option? Now, this is where the concept of delta comes in. You might have heard about delta in some of the other Greeks. However, I know that this can seem intimidating, and so people tend to not want to focus on the Greeks at all out of fear of not being able to grasp the idea. But I will show you the easiest way to understand delta. And this, for this example, this is really going to be the only Greek that you will need to focus on. And it is going to be crucial in your quest to buy LEAP call options on stocks that you really want to own and stocks that you really have a bullish outlook on, for 2-3 years down the road, where you can make a significant amount of money with a smaller capital investment. So let us take a look at Delta. Again, Delta is going to be the thing that tells you how much money you are going to be making with the call option. Now, delta is represented as a decimal, as a ratio, right? So let's just say, for instance, that you have an option that has a 0.5 delta. What does that mean? Well, all that means is that for every dollar that the stock price goes up, right? So for every dollar that the stock goes up, the option will make 50 cents. So it moves at half of the value of the stock. That's all that means. Delta just means the amount of money that that call option will gain based on a $1 move in the stock. Now, there is a general rule for LEAP call options that you essentially want to engage in LEAPs that have a 0.8 delta and above. Why is that? Well, essentially because you want to mimic as close as possible the gains that the stock will make, right? So for 0.08 delta, again, that means that for every $1 that the stock goes up, right? In this case, let's just pick NEO. For every dollar that the stock goes up, NEO, the call option on NEO will go up by 80 cents. So really, 20% less than the stock price. Now, well, you might think to yourself, well, why are we going to be taking less than the stock price? Well, because 0.8 is really the sweet spot between mimicking the stock's movements and getting a hefty discount on 100 shares of stock. What do I mean? So let us take a look at a real life example now. So if we go out, again, if we're bullish on, let's just stick to NEO. We're bullish on NEO. We can go out to let's just say the January 2022, that's more than a year out. And obviously, we have a bullish outlook on the EV market in China. It is by far and large the biggest EV market in the world. They have aggressive plans to replace all of their cars with EVs in general. And NIO is one of the leading companies, at least in terms of marquee brands of EVs in China. Now, we want to buy NIO for the long term, but we don't want to spend $5,400 on 100 shares of stock. Well, here's what you would do. We would then look for a strike price that has a 0.8 delta or above. How do we find the delta in Robinhood? Well, it's easy. You just click on the strike price that you want and you get all of the Greeks right here. And you see delta. The $40 is almost 0.8, 0.79. So let's use this as our example, right? So this has almost a 0.8 delta, the $40 strike. And how much is it going to cost us? This is the important part. $26.65. Remember, you have to multiply it by 100 because each options contract represents 100 shares of stock. So instead of $5,400 to buy 100 shares of NIO, this is going to cost us $2,665, and we get to control 100 shares of NIO. And the most important part, the delta is 0.8, meaning that for every dollar that NIO moves up, for every dollar that NIO stock moves up, this option will move up 80 cents. So we get 80% of the stock movement, but it's only costing us half. So instead of $5,400, it's costing us a little under $2,700 to gain 80% of the stock's movement on a stock that we feel supremely bullish about. So let us break the numbers down really quickly in terms of profit and loss. So if NIO costs $54 right now and we bought 100 shares, right? Again, that's going to cost us $5,400. That option, that $40 strike price option with the 0.8 delta was $26.65 times 100. So this is only going to cost us half, right? So $2,665. This is how much it's going to cost us versus $5,400. Now, let's just say within the period of a year, at some point, NIO ends up being $75, right? So let's just say that right now, NIO's stock price is $75, somewhere in the span of that year, right? So NIO is $75. Well, what does the profit and loss look like for each scenario? So here, let's take a look at the stock scenario, and then we'll take a look at the LEAP scenario, right? And what is our profit, our percentage profit? So 75 divided by 54 gives us, let me pull up a calculator here. So 75 divided by 54 gives us 38.89%. Let's just round it up, okay? So 38.89%. Wow, that is really sloppy in profit. Now, here is what the LEAP would generate for the same exact move. So NIO increased by, the stock increased by $21, right? Remember, this LEAP has a delta of 0.8 delta, which means that for every dollar that NIO goes up in stock price, the option goes up by 80 cents. So naturally, a $21 move times 0.8 would mean that NIO moved up $21 times 0.8 means that the LEAP moved up $16.8. So let's add 16.8 to the 26.65 that we bought it at, right? Because this is now ostensibly the value of this LEAP call option. So we get $43.45. So let us go in here and do the same exact thing that we did for the stock. So $43.45 divided by 26.65, and we get 63% profit. 63% profit on the LEAP call versus 38% profit on the stock. And it cost us half as much to get in. So in essence, the power of LEAPS and options in general, it has this leveraged factor, right? Because you can control 100 shares of stock with a less of a capital investment, you are able to really leverage your position and make much more than you would on just the stock itself. Now, obviously, the caveat being that you could be wrong on your outlook and you have a time expiry. In this case, it's not so bad because we're talking about over a year. And if things change, you could sell your LEAP option early You don't have to wait for expiry. So that's the other thing that beginners might ask about. Do you have to wait until expiry? No, you don't. You can sell it at any time. And even if it's up, you could sell it for profit. If it's down, you could sell it for a loss and exit with minimal harm. So you're not bound to this option all the way until expiry, even though the expiry date, is on a certain date. You're not obligated at all to hold it until then. You could sell it whenever you want. And lastly, I'll go over a really quick example on ThinkOrSwim. Let's just take Palantir, for instance, a stock that a lot of analysts, including myself, are really bullish on in the future. And let's just take the January 2022 calls. You can see that its current price is $27.66, the current price of the stock itself. And we can go down here and in ThinkOrSwim, you actually have the delta right here, as opposed to in Robinhood where you have to click the strike and then, it will show you the Greeks below the fold there. Here, you can actually have a column that has all of the deltas here that you see here. And the 0.8 delta will be at the $20 strike price. And this would actually be a perfect time if you're bullish on Palantir, because like I said, when the stock price goes down, the price of call options go down. And see, all of these call options here are discounted because we had a little bit of a drop on Friday when the market closed. So in this case, we could buy the $20 leaps on Palantir for $14.70. Remember, we have to multiply this by 100. So $1,470 to control 100 shares of Palantir, as opposed to paying $2,766, which is based on the stock price. And the same thing applies for every dollar that Palantir moves up in its stock. That call option right there will move up 80 cents based on the stock movement. That is it for this video. I hope you guys got something out of this video. If you got anything, absolutely anything out of this video, leave it a big fat thumbs up. Again, sign up if you want access for two things. One, if you want access to our trading group where I send out all of my trades, my portfolios. There are over 1,000 traders in there discussing insights, analysis, entries, exits, watch lists, etc. Link is in the description. Also, if you are interested in a full-on options course, a pre-recorded one where you will be able to reference until the end of time, please sign up. Let me know in the email list below. You will get a nice early bird discount when I do release it. So I will put that form in the same description area. I'll also leave it as a pinned comment, right? So sign up and let me know that you're interested, and that way I will notify you as I get closer to finishing the course itself. As always, I appreciate you guys. Leave it in the comment section below. Let me know if you are engaged in any leap call options, or if you're about to based on this video, and what stocks you are interested in doing leaps on. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.